Hey folks, it's Simo from Investment Research, November 11th, 2025. Let's get right into it. The stock closed flat at $2.52 today after dipping to $2.41 in the morning and scraping back up. No big moves, no drama. And honestly, after a 35% slide year to date, that quiet day feels like the market's catching its breath. Not from old meme hype, but from the actual business holding steady. So today, we're keeping it straightforward. I'll walk you through the fresh Q3 numbers, what they really mean, a no BS look at the road ahead, and your simple choice quick flip or long haul hold. This is about making a smart call, not chasing shadows. The price today? It traded in a tight 7% range with light volume all day. Over the last 10 days, it's edged up 5 times. Sure, it's down big from those wild 2021 peaks nobody saw coming, but the floor seems solid. Why? Because last week's earnings didn't spark a sell-off. Instead, folks are waiting for the holiday rush to show if crowds return. When a beaten down stock like this sits still without crumbling, it usually means the core story, movies, tickets, popcorn, has enough glue to stick around. Speaking of earnings, Q3 came out November 5th, and it's a mixed bag that still beat the low bar. Revenue landed at $1.3 billion, down 3.6% from last year, thanks to an 11% drop in overall box office attendance. But here's the key. It topped Wall Street's guess of $1.23 billion by a solid 5%, and AMC grabbed 24% market share in the US, up from before. Loss per share, 21 cents, right on target, though wider than last year's 4 cents due to one-time hits from refinancing debt. Adjusted EBITDA, that's earnings before the messy stuff, hit $122 million, down from $162 million, but still above what analysts predicted. Food and beverage revenue per person, a near record $7.74, up because folks are splurging on premium snacks. Tickets averaged $12.25 each, highest ever. So even with fewer butts in seats, AMC made more cash per visitor, up 9% from pre-pandemic days. Loyalty programs pulled in over 2 million subscribers, adding steady fee income that doesn't rely on blockbusters. Dig a bit deeper, and the balance sheet shows a company that's clawed back from the edge. Cash sat at $366 million end of September, enough to cover day-to-day without panic. Debt's still a beast at $4.5 billion, but they smartly refinanced $173 million in July at lower rates and swapped another $183 million into stock. Just last month, they knocked out $40 million more in notes without spending a dime or issuing new shares. That's part of a bigger July deal with creditors. $223 million fresh cash to tackle 2026 maturities, plus up to $337 million swapped for equity. Net result? Debt drops about $325 million overall. It's not fixed overnight, but it's progress. No defaults looming, and liquidity covers the short-term crunch. Compared to 2021's near meltdown, this is night and day. Cash flow tells the turnaround tale too. It burned $81 million last quarter, better than the $92 million hole a year ago, as they invest in theater upgrades like more IMAX and Dolby screens. Trailing 12 months, free cash flows negative around $100 million, mostly from debt paydown and premium builds. But that's the trade-off. Spend now to charge more later. With 223 IMAX and 177 Dolby spots already, plus plans to add 25% more Dolby by 2027 and double premium auditoriums, they're betting big on high-ticket experiences, and it worked. Stuff like Taylor Swift's Eras Tour concert film pulled $50 million in one weekend earlier this year. Alternative content like that fills gaps when studios hold back. Now let's talk future without the fairy tales. Analysts and company execs are eyeing 2026 as the real pivot. Box office for next year? Expected to roar, up dramatically from 2025's projected $8.5 billion domestic, thanks to a stacked slate. Think Marvel's Avengers, Doomsday, Star Wars, Mandalorian and Grogu movie, Jurassic World Rebirth, Avatar 3, Mission Impossible 8, Super Mario Bros. 2, Mortal Kombat 2, and even Michael Jackson's biopic. Amazon MGM alone is dropping 10 theatrical films with a $1 billion budget. Warner Bros. Is ramping up too, after holding back this year. If attendance rebounds to 800 to 900 million tickets, back to normal levels, that's flat to 5% revenue growth for AMC. EPS from a 21-cent loss this quarter to about 41 cents loss full year 2025, then break even or better in 2026 as pricing sticks. EBITDA margins, 9% now, climbing to 10 to 12% on premium plays. Free cash flow turns neutral by late next year, positive in 2027 if debt keeps shrinking. Valuation-wise, at 0.4 times next year's sales, it's dirt cheap for entertainment. Peers trade higher. Fair target, $3.50 in 12 months, a 39% bump from $2.52. Analysts average $3.28, with highs at $4.50 if movies deliver. Not screaming buy, but undervalued if the industry heals. Your move, plain and simple, for a quick trade, snag it under $2.40, flip at $3. Holiday hits like that Swift sequel could spark a 20% pop short term. Low commitment, but watch the volatility. Old meme traders can rattle it. For 1 to 3 years, hold or add in chunks. Push to $4 to $5 as debt eases 20% and box office steadies. CEO Adam Aron's all-in on global expansion and AI for ops could juice margins without more seats. Longer, 5+ years, riskier. But $6 plus if theaters evolve with live events and streaming tie-ins. The industry's not dying, it's shifting to premium, and AMC's leading that charge with 900 spots worldwide. Risks? Plenty. Flop films mean emptier halls. Q4's do or die with fewer releases. Debt at 3 times EBITDA bites if rates climb. Streaming's still stealing eyeballs. And leaner rivals like Cinemark are nipping at heels. But AMC's scale and loyalty base, those 2 million subs paying monthly, give it an edge nobody else has. My straight take, hold if you're in, add only if you're in for the rebound. Target $3.50 next year. Why? Earnings beat the whisper numbers, debt management's working, and 2026's slate is loaded. Execs call it explosive growth. The price bakes in the pain already. When attendance ticks up even 5%, shares follow. Quiet day today? Post-earnings digestion. Eyes on Q4 in February. That's the proof. Look, AMC's no sure thing. It's a fighter in a tough ring. But with smart pricing, debt cuts, and a blockbuster pipeline, it's adapting, not just surviving. If you believe big screens still matter, this underdog's got legs. That's the breakdown. Do your due diligence, but for a speculative play with real turnaround juice, AMC's worth a ticket. Thanks for tuning in. Catch the next one tomorrow. Stay steady out there.